Fund savings plan. With or without a robo-advisor. In times of persistently low interest rates, fund savings plans offer a suitable alternative for investing capital profitably. But what is the best way to go about selecting funds? Take the initiative yourself, or should the robo-advisor decide? Mutual funds are financial products that are controlled by fund managers. These professional analysts invest in the securities that are suitable for them based on their own experience and the defined strategy. These are primarily stocks, bonds, or a mixture of both. As an investor, you can invest in a simple way and do not need a great understanding of the stock market as the fund manager selects the respective securities. In addition, the capital is already diversified in a fund, which means that the risk is lower than if you were investing in individual stocks. As an investor, all you have to do is choose the right fund for your risk level or opportunity profile. In order to spread the risk wider, it makes a lot of sense to invest in several funds at the same time. Minimum investment amounts for investment funds. If you want to invest in mutual funds, minimum investment amounts must be paid via the respective custodian banks. These are usually $250 or $500. However, $1,000 can also be incurred. Due to the size, these minimum investment amounts are the first hurdles for many small investors to invest money in funds. But there is another way. There are so-called fund savings plans. With this instrument, almost every saver can invest money in funds by himself. This is because you pay a comparatively low monthly amount, usually $25 or $50, depending on your bank, into the fund you have selected yourself. A fund savings plan is suitable for medium and long-term savings goals. It is important to make regular deposits. You can simply ignore temporary developments on the capital markets. Fund savings plans can be used for your own retirement provision, as part of the financing for the purchase of real estate, or for the education of the children. Robo-Advisor and fund savings plan. A fund savings plan can therefore be a very good solution for saving capital with small sums. Investors do not need in-depth knowledge of the stock market, but you have to choose the appropriate funds yourself and decide which fund would be the right one. Of course, this takes a little time. Robo-advisors can help whoever would like to be supported in this regard and are not afraid that an algorithm will make the decision. In Germany there are currently around 40 providers, which differ slightly in what they have to offer. Either they act as an advisory tool. Here the investor buys the funds himself after creating the portfolio. They also offer pre-built portfolios in funds or complete portfolio creations and management. With a few exceptions, investors can also fall back on fund savings plans. Last but not least, robo-advisors differ in the amount of saving plan installments, administrative costs, and the variety of risk classes. So, what is the recommendation? How investors should proceed in order to get hold of the right fund savings plan is up to them to decide for themselves. If you want to deal with mutual funds and the stock market as little as possible, then robo-advisors are a quite good solution for investing. Requirement: you trust the algorithm. However, since most providers have only been on the market for a maximum of 3 years, there is no long-term history. If you want to take the reins into your own hands during the decision-making phase, then the classic fund savings plan is more suitable. This way you act independently and set individual accents.